All right, what we're going to talk about today is DSCR home loans and investing with non-QM or non-traditional financing. So what I want to do is kind of talk about myself shortly. Been in this industry 24 years, been rated pretty well. Programs that were specialized in investment, asset utilization, jumbo investment, construction, bridge financing. So today's roadmap is to growth foundation, why real estate builds wealth, leverage, and four ways folks make money. Looking at DSCR and non-QM solutions, choosing the right program. The BRRRR strategy, short-term portfolios and scaling a portfolio. So why real estate still builds wealth? The core advantage is appreciation over time, monthly cash flow, principal paid on through amortization, tax advantages, in general terms, a hedge against inflation, ability to use leverage. So the four ways: appreciation, which is property growth over time, cash flow, which is monthly income, loan amortization, equality built through principal pay down, force equity, right? So building wealth with leverage, using financial control, larger assets while preserving capital. What the way? Well, return on equity versus return on cash invested. Opportunity cost of capital tied to one property, liquidity needs across entire portfolio. Types of investment properties, residential, but it should be your single family rentals, condos, 2 to 4 units ADUs. Larger specialized would be multifamily, vacation rentals, mixed use, right? There's an array there. So traditional versus our non-traditional or non-QM financing would be conventional loan, which is using full income documentation, personal income qualification, strongest pricing for qualified buyers. Now, DSCR, it's very simple. It uses the rental income of the property to help qualify. So the property cash flow is the qualification. No personal income documentation is often needed. You do have to prove assets for down payment, reserves, strong credit, but it's a fast, streamlined process. There's also bank statement loans that are available or profit and loss loans for those who are self-employed. So there's a lot of options here. Now, what is DSCR loans? Debt service ratio. Essentially, we're using our debt service coverage ratio. What makes it different is no tax returns needed, no W-2, no personal employment verification. The property qualifies primarily on its own cash flow. So the property tells a story, not your personal income. How DSCR is calculated, it's a monthly rent divided by the monthly overall housing payment from the mortgage, taxes, insurance equals the DSCR. So what the above number means, above 1% generates more income than the housing payment. Around 1% breaks even. Below, the payment exceeds income. So some lenders will adjust this and allow it with adjustments, right? So different lenders may treat these ranges differently. So you will always want to ask about the specific program's requirements. DSCR in action. Here's an illustration. Let's say the month is 3,000, but the mortgage payment is 2,500. That DSCR is 1.2, generates more income than its payment. So who should use a DSCR? Experienced investors, scaling a portfolio, self-employed borrowers with complex income, high income earners who want a faster process, and how to stay investors buying remotely. Bank statement loans, how they work, qualification based on 12 or 24 months, built for business owners and self-employed investors, and avoid the income compression that we have with tax write-offs. Asset utilization is ideal for retirees living off investment accounts, high net worth borrowers with substantial reserves, borrowers with significant trust income. Profit and loss programs, we look at the profit and loss statement, usually a CPA prepared profit and loss statement, and situations where bank statements alone don't tell the full story. So choosing the right investor loan, DSCR is again for based for non-owner occupied non-occupied parts and for property-based qualification. Bank statement is for self-employed borrowers, 12 to 24 months. Asset utilization, best for asset-rich, income-late borrowers, common for retirees, and conventional is really best pricing for well-qualified borrowers and portfolio lending for larger holdings. So the BRRRR strategy, right? Buy, say you purchase the property, then you rehab that property, you then rent it out, refinance it, and then you repeat and purchase another property. This is that strategy where you buy property by property. And candidly, if you're living in the property for a year or so, you could get away with as little as 3 to 5% down, depending on the program and the qualifications. And then refinance it once it becomes a rental property after you had rehabbed the property. A great strategy to develop wealth, and that's really a classic strategy. Alternative entry point is house hacking. Living in one unit, let's say it's a duplex, triplex, or fourplex, bring the remaining units to offset it. Using an ADU is another strategy for single family property, and owner occupied financing options are available while building investment experience. It's a great way to get started. Short term rentals. So, general lender considerations here are allowing for short term rentals to qualify. We have to document a little bit differently. We have to look at the short term rental analysis, also regulations in that area. Often counties and cities are now prohibiting them. So we have to actually underwrite the property for that as well. So midterm rentals, common tenant profiles, traveling healthcare professionals like your travel nurses, corporate relocation housing, students needing a semester length stay. This category has grown significantly and offers an alternative both long and short-term rental strategies. Fix and flip financing, bridge loans for fast acquisition, construction financing for major rehabs. And you definitely want a clear exit strategy in any of these cases, and you want to plan out before the purchase. Portfolio growth strategy. Early stages, buy one property, learn the process. When you scale, you buy 3 properties, maybe buy 5. Maturities, when you have 10 or more properties, then you shift towards portfolio level financing. Cash out strategy. Using the equity to acquire the next property. What to weigh? Available equity in existing properties, new payment relative to rental income, overall portfolio leverage and risk tolerance. Responsible leverage means growing the portfolio with overextending it. Renovation financing. Common projects, kitchen and bathroom updates, ADU additions, and garage conversions. Force equity through renovation is one of the 4 ways that investors build wealth from slide 5. So, ground up construction financing. Ground up new construction, spec homes for built sale, built to rent strategies, or ADU construction on existing rental properties are kind of the key things we see there. So, understanding reserves, what to maintain, general liquidity beyond the down payment, emergency funds for unexpected vacancy, maintenance and capital expenditure reserves. Common mistakes, over leveraging, huge mistake. We saw a lot of that 20 some odd years ago. I'm sure, as you know, they wrote a book and a movie on it, right? But it's something that we'd say not to do. Obviously, you want to make sure you do it timely and making sure that things work out well. Poor cash flow analysis before the purchase. Ignoring ongoing maintenance costs, don't do that. Not maintain adequate reserves, don't do that either. Buying emotionally instead of analytically and choosing the wrong financing strategy. So tax plan considerations, topics worth talking to your accountant. Depreciation, 1031 exchanges. I have a full presentation on that, by the way. Cost segregation studies, entity ownership structure. Coordinate with a qualified CPA on all of these topics. If you need one, we have quite a few we'd love to refer to you. LLCs and ownership structures, common structures, personal ownership, LLC ownership, trust ownership, partnership structures. Consult a qualified legal professional before choosing the ownership structure. Insurance for investors. Landlord-specific policies, umbrella policies, vacancy provisions, flood coverage where applicable, and short-term rental insurance if applicable. Market selection, what to value, cash flow potential, appreciation trends, rent growth trends, population growth, local employment strength, neighborhood level analysis. Mortgage cost analysis is what we tend to do. It's a full analysis, but it's a presentation built into it. So we'll go over things like 20, 25%, 30% down, various loan programs, what have you. But we really do to work through these items with you. And real investor case studies would be looking at some of these things that we had as real scenarios. We had a first rental property. A client never owned a property before, but they did a down payment. They wanted to buy an investment property. They bought actually a condo in Oakland, California. They used a DSCR loan for that purchase. It's actually a better rate than conventional at that time. No personal income documentation was required, and we closed in about 15 days. The Burr investor. We've had a lot of these because I've done it myself. But we had a client who purchased with cash. They renovated and refinanced afterwards. So it was a gift from a family member that bought the property cash. They did what we call deferred financing. They then refinanced that property and then decided to purchase another property. And then since then, they bought, I think it was 5 properties now in the last 8 years that they acquired, which is pretty incredible, right? Some in state, some out of state, but they did well. Short-term rental owner was someone in Palm Springs. They used a DSCR home loan, and the rental income in Palm Springs supported the financing. So we had to confirm with the county before the purchase, as well as the city, that it would work, that it was okay to permit. We restructured cash flow around the seasonal demand, and it worked out great. They got a great rate, closed again in 15 days. Portfolio investor, another one that we had, scaled from 5 to 15 properties. And so we transitioned to portfolio level financing, and then they maintained disciplined reserve requirements throughout, which is super important. So building your investment team, the investor, you want to work with a solid agent in the market that knows the market really well. Mortgage advisor, our team, help guide through this scenarios with you. A CPA who could provide tax strategy and entity planning. Property manager, which handles the day-to-day operations, and insurance attorney. For sure, if you have an attorney, like a trust attorney, just talk to them about it. If you have a trust, I would say, obviously, talk to them about adding these properties if you acquire more. into your trust. But insurance, making sure you're aware of insurance even before you make an offer on a property. So frequently asked questions are, do you file without tax insurance? Often yes, through DSCR non-QM loan programs, as we mentioned. Can LLCs purchase? Often yes, due to guidelines. How many properties can you own? It varies by program, but conventional only allows for 10. I have clients that have 20 plus properties. Can you use projected rental income? Yes, but it's subject to the appraisal. The appraiser is actually going to look at comparable rents in that area, especially if the property is vacant. So why investors work with our team? Deep knowledge on DSCR and non-QM expertise. We are a direct lender, plus we can broker if we have to. Fast responsive approvals. We provide a full analysis for every scenario. Long-term portfolio planning, not just single transactions. I myself am an investor. I own several properties myself. I know it really well. I know the ins and outs. We've had wins, and yes, we've had losses. And I'm more than happy to share those experiences. So your investment roadmap, acquire your first property. Step 2, let's say year 3, build a portfolio. Year 5, scale strategically. Year 10, financial independence. We have a bunch of investor resources, worksheets, calculators, bird planning guides. Reach out to me, shoot me a message, or schedule a call with me. I'd love to get these down. Next up should be schedule an investor strategy session, review your goals, analyze your portfolio, and develop a plan. So there's my contact information. Link to connect with me is below as well. Feel free to call, text, email, or just schedule a time to meet with me, and then love to get a call and discuss some planning with you.